Investing doesn't mean being good at stocks or predicting markets. Almost everything people invest in fits into three big buckets, like food groups. If you understand these three, you understand most of investing, and everything else is basically a variation. Those three are stocks, bonds, and real estate. Start with stocks. A stock is ownership. When you buy a stock, you own a tiny piece of a real business. If that business grows and earns more money, your piece can become more valuable. Stocks make money in two ways. First, the price can go up, meaning you sell later for more than you paid. Second, some companies pay dividends, which is cash sent directly to owners. Most people don't buy individual companies. They use index funds or ETFs, which hold hundreds of stocks at once. Stocks are powerful because they've delivered the strongest long-term growth, but they feel risky because prices can drop sharply, sometimes for years, before recovering. Next are bonds. A bond is the opposite of a stock. You're not an owner, you're a lender. You give money to a government or company, and they promise to pay you interest and return your money later. Bonds mostly make money from those interest payments. They usually move less than stocks, which makes them feel boring, but useful. The main risk is interest rates. When rates rise, existing bonds become less attractive and their prices fall. Bonds don't make you rich fast, but they can steady a portfolio and provide predictable income. Finally, real estate. Real estate investing means owning property that can produce rent and rise in value over time. One unique feature is leverage. With a mortgage, you can control a large asset with a smaller amount of cash, which magnifies gains and losses. You can invest directly by owning property or indirectly through REITs, which trade like stocks. Real estate can provide income and diversification, but it comes with complexity, debt, and less flexibility. There's no single best choice. Most investors combine all three. Stocks drive growth, bonds reduce shocks, and real estate adds income and diversification. That mix matters more than picking the perfect investment.